Well, greetings, my beloved clients and friends. Wanted to do a video because there was some pretty significant pullback in the market yesterday after Powell cut rates and announced his plans for the following year. So I just wanted to give some commentary on that. So just to get you caught up, yesterday Powell lowered the overnight rate by another 0.25%. So this was the third rate cut in the last 3 months. He did a half in September, and then a quarter right after the election, and then he did another quarter yesterday. So a total of 1% of rate cuts in the last 3 months. Okay, and when he started these rate cuts in September, he said, I think we'll probably do 1% this year and then another 1% next year, because we have tightened. I think it's time to end that tightening cycle, is what his plan was in September. So the market was expecting, based on what he said, 1% this year and another 1% next year, right? So they got the 1% this year. He delivered. He gave them a half in September, a quarter in November, and a quarter yesterday. But in his commentaries, he said, you know what? Next year, from where I'm looking at now, he said, maybe we're going to lower it another half. Okay, so that was a change from his statement in September when he said we're going to lower it another full percent in 25. So the market was upset. They wanted another full percent for next year, and now it looks like they're only going to get a half. So that's why we got the sell-off. And let me tell you, it came as no surprise to me. In the last month plus, when I've been doing reviews with clients, they've been asking me, so what do you think about, what do you see going forward? I said, well, now that the election is behind us, the uncertainty from who's going to win has been resolved. So the market felt comfortable committing some money back into the market. So we saw a pop from that. And we know what Trump's economic policy is going to be. So, now they're starting to make bets like, okay, these are the sectors that are going to benefit, and these are the ones that might face some pressure. So money was able to go into the market based on, now there's a more clear picture of the future, right? That's been helping the market in the last quarter. The second thing, these rate cuts have been helping the market. But I said, know what? Two things that I don't think is going to go straight up, obviously, which it never does. And the reason is, at some point, the market is going to get disappointed that they're not going to get their full 1%. I mean, you could see that coming from a mile away. And the second thing is, there's a saying on Wall Street, you buy the sizzle and sell the steak. So what that means is Trump's made a lot of really exciting promises of what he's going to do. Drill, baby, drill, and tariffs and lower taxes and ease regulation, right? All these things the market is very excited about. Now, that's the sizzle. The reality is that there's a highly likelihood that he's not going to be able to deliver on 100% of his promises. So at some point there might be some disappointment, right? That's just the reality of how things are. You make a lot of promises, and any politician, makes a lot of promises, and then the reality is once they get into office, opposition and different things will impede his ability to fulfill every single one of those promises, right? So that's the steak, right? The sizzle is all the promises. The steak is the reality. And so there's usually a little bit of disappointment. So, at some point we're going to be disappointed that we don't get 1%. At some point we're going to be disappointed that he couldn't deliver on every one of his promises. So we might see some volatility in the market. But generally, I was telling people that it seems like there's a tailwind. Generally, it seems like there's a tailwind. I think overall, 2025 should be pretty good. Inflation is almost to where Powell wants it. He wants it at 2. It's right around 2.5, so it's pretty close. He's getting close to where he wants it to be. That last half might be tough because, you know, Trump's policies tend to be stimulative, and yeah, unemployment seems pretty good. Unemployment's in the low 4s, which is a pretty healthy place for it to be. So why did we see this coming, and why were we not surprised that he backs off away from the 1%? Well, here's what, just to give you a background of where rates have been. So after COVID and the supply chain disruptions and all the stimulus that went into the market, inflation shot up to 9%. And Powell reacted. He was a little bit slow to react, but when he finally did react, he reacted very aggressively. In under a year, he took rates from 0 to 5.5, okay? And then he held it there. So imagine he's trying to restrain the economy, and he puts a chokehold on it, and he tightens and tightens and tightens and tightens, right, till he gets it to 5.5, and it's really tight, right? Especially from 0. To raise it from 0 to 5.5 is really tight. He did that from the beginning of 22, like the spring of 22 to the spring of 23. Tightening, 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 tightening. And then he held it. He held it tight. He didn't make it tighter, but he also didn't make it looser. He held it in a tight position for over a year, for a year and a half, from the spring of 23 to the fall of 24. He held it tight, which is still restrictive. Okay, and then finally in September, he started to loosen. Now, that doesn't mean it was stimulus. It was just less restrictive. He restricted that chokehold a little bit in September, a little bit more in November, and a little bit more last month. Okay, so why was that restrictive? Is because he took the overnight rate from 0 to 5.5. Well, the 10-year rate went from like about 2.5 to 3.5. So he inverted the yield curve. And because he could only control the front end, the market controls the long end, and so it was upside down. The short, you would expect that if you were to borrow money overnight, the rate would be lower than if you were to borrow money for 10 years, because that's more risk. So the lender's going to charge you more in general if you're going to not pay him back for 10 years versus that you're going to pay him back tomorrow. Okay, so you would generally expect overnight rates to be lower than 10-year rates, right? But that has not been the case for over 2 years. And for over 2 years, we've been in an inverted yield curve, which is very restrictive. So to ease restrictions, he said, I want to get the overnight rate back under the 10-year rate. At the time when he said that, when he did the first rate cut, the overnight rate was 5.5 and the 10-year was 3.5. So he figured, I'm going to have to lower that overnight rate 2% to get it down under 3.5, under the 10-year, right? So he said, I'm going to do 1% this year and 1% next year to get that overnight rate underneath the 10-year. So he figured over the next year and a half or so, he was going to get that overnight rate under the 10-year. But what happened? He lowered it a half. So now the overnight rate was like at 4 3/4. But the market has brought the 10-year rate up. Yesterday, the 10-year rate went over 4.5. So in those 3 months that he has lowered the overnight rate 1%, the market has raised the 10-year rate by 1%. So yesterday, was the first day in over 2 years that we have not been in an inverted yield curve. that we're now in a normal sloping inverted yield curve. The overnight rate is under 4.5. The 10-year rate is over 4.5. So his work is basically done. He doesn't need to lower rates anymore to get the overnight rate underneath because the 10-year went up. Okay, so obviously he's not going to have to lower another 1% next year. Let me take this another step. We might not even get a half next year. There's room for the market to get disappointed again and throw a little tantrum again if he doesn't give them a full half next year. That's a possibility. So why is the 10-year gone up? Well, the 10-year rate is often called the risk-free rate. It is, and if you were to say what is built into that rate, it's basically GDP plus inflation. So if you expect inflation to be 2% and you expect GDP growth to be 2%, you would expect to see like a 4% 10-year treasury, right? It's just like the risk-free rate or the cost of money. Money has to get at least the rate of GDP plus inflation. So with the 10-year going up from 3.5 to 4.5, that's suggesting that the market feels like either we're gonna see inflation a little bit higher than what we thought, or we're gonna see GDP a little bit higher than we thought, or both, right? So, I mean, if Trump's doing all this stimulus, it's gonna be really hard for rates, for prices to come down, for inflation to really come down to that 2%. And if he's stimulating the economy, there's gonna be some GDP growth, right? More than 2%, you know? So these are generally not real negative things. The other reason the Fed would need to raise rates is to stimulate a struggling economy. There is no struggling economy, so there's no need for any type of stimulation. So I'm just saying we might not get the half next year either, because I think it's possible that we could see a 10-year at 5%. Where the market's factoring 2.5% inflation and 2.5% GDP growth. And we see a 10-year at 5. If we saw that, there would be really no need for Powell to continue to lower those rates, right? So what I'm saying is there was kind of a healthy rally in the last quarter since Powell started lowering rates and since the election uncertainty was resolved. And since Trump's policies have been announced, all those things have contributed to a really nice rally in the last quarter. So if we gave back a little bit yesterday, I don't think that's the end of the world. The market had to throw their tantrum, and now they're going to get back to work with a recalibrated expectation of rates. But like I said, we might not see that half. There may be another tantrum coming in the next whatever 6 to 12 months when they realize that rates do not need to go down, that overnight rates do not need to go down that much more. Okay, so was I surprised? No. Am I worried? No. We're just continuing to press on. In effect, the fact that he does not need to lower rates 1% next year means the economy doesn't need his help. Okay, that's what it means. And if anything, the economy might be so strong that he doesn't need to loosen up that much. He needs to hold the reins a little bit so it doesn't run away from him. Okay, so that's because the economy is healthy. It's not because the economy is weak. So we're not worried about it. We weren't surprised, and we're just taking it with a grain of salt. If anything, maybe it's a slight buying opportunity. we did have a little bit of cash on the sidelines, and you know, we might start deploying it after what we saw yesterday. Okay, so I hope that gives you some color on what we're thinking about as the result of what happened in the market yesterday. If you have any questions, feel free to reach out to us, and again, enjoy the holidays.